Well, 2020 is over, and what a year it was. We had a global pandemic, a recession, all-time highs in the VIX, which is a volatility index, and the end of an over decade-long bull market. So lots to talk about. Just want to do a quick market review, see what happened in the year. Also want to talk about one of the biggest mistakes that I think investors made during 2020. And then finally, just want to take a quick look at how the stock market's done under Democratic presidents and Democratic Congresses in the past. So here we go, let's jump into it. So definitely an interesting year. As we all remember, everything kind of hit in March and we had a significant drop in the markets. But since then, we actually had a nice recovery. So the fourth quarter, just to kind of catch up on that, is where we saw most of the final returns coming through and portfolios turning positive for the year. So if you look at really the US stock market, which is about 56% of the global stock market, there was a roughly 14.68% return there. If you look at international developed markets, which is roughly 30% of the markets, 15.85% return. And then emerging markets, which is the final roughly 13%, we saw a 19.7% return there. So for the fourth quarter, we saw really strong returns. As we back up from there and we take a look at really how the whole year went, this chart really sums it up, just the large drop in March. But for the whole year, we saw the US stock market return about 20.9%. International developed stocks returned about 7.6%. And emerging markets, a little over 18 at 18.3%. So in the end, after everything, we had a higher than average calendar year for the US stock market. So that actually brings me into what I think the biggest mistake investors made during 2020 was. So let's take a look at this chart. We can see, here's what the market did for the year. And then if we overlay onto that some information about what investors were doing. Really what this is showing the weekly flows into money market funds. And if we take a look at these weekly flows, you see a significant jump during the drop in the markets in late February and early March. That's investors selling out of their investments and going into cash in their portfolios. So we see most of this cashing out of investments happening toward the bottom of that drop. And then you do see some money trickling back in toward the later periods of the year. But a lot of money exited the market right before the market turned around and had a nice recovery. So let's just take a look at some numbers here. If we look at the weeks with net inflows into money market, which is outflows from the stock market, people selling their stocks, you see roughly 1.4 trillion leaving the markets. Now, had that money been left invested, it would have turned into over 2 trillion. So that return there that was missed is just over 41.4%. It's almost 41.5%. So that's the return those dollars would have received had they stayed invested. And, it's also true that if you look at when people got back in, so, the net flow was out of the markets. Most people didn't get back in. But if you look at the dollars that did come back in, those dollars would have averaged a little over 14%, so 14.22%. The average return for the S&P 500 was around 18. So the dollars that got back in, even they didn't actually do as well as they would have had they just stayed invested. So again, it's a story about just investor emotions and the decisions that investors are wanting to make at different times based on what's going on. We've said this time and time again that the best way to have success in the stock market is to develop a long-term plan, to build out a diversified portfolio, and to hold that over long-term timeframes. And this is just a case in point as to why. Investors, we're not wired as people or as humans to be good investors. We're fearful during times when we should be optimistic. And we're optimistic in times where, markets have done really well for a long time and maybe we should be a little more conservative. So managing those emotions along the way during times like this and years like 2020 is incredibly important to having long-term success in the stock market. So all that said, just want to close here with a couple charts to show how the market has done under different presidencies and different Congresses. So if you look at this first chart, this shows presidencies. So you can see blue being Democratic presidencies, red being Republican. Again, it's hard to really look at this and say that there's much of a relationship or conclusion that can be drawn from it. The market has moved up under both types. It's also moved down over both types. So just something to look at here. We've seen markets historically do very well under both types of presidencies. And the same thing's true if you look at Congresses. So this chart looks a little bit different because you can see sometimes where they were mixed. So maybe one party had the House, one party had the Senate. But again, the same relationship holds. So 2020 was an interesting year. I think the takeaway is we're all better investors now, and we have a better sense of what our risk tolerance is, and we see that volatility is normal, and it does happen in the markets. After a 10-year bull market, we were sort of lulled to sleep by just the kind of constant uptick that we were seeing. And this is a good reminder that volatility does happen in the stock markets. It's also a good reminder that we need to stay invested and stick to our long-term strategy in order to have success. So, as interesting as the year was, for those of us that stayed invested and rode out the volatility, it ended up being a pretty good year in the stock market. So, as always, if you have any questions, please feel free to reach out. We're here for you, and we'll talk to you soon.